All right, welcome back to the show. I'm going to bring on our next guest, Tucker Maxwell with Guild Mortgage. Welcome to the show, Tucker.
Hello, Dan. Thanks for having me.
All right, so you've been here before. We're going to kind of do a current update. We talked about all the carnage just in the last segment, of course, but we have a specific topic, and this topic is a tool, the tool in your realtor's tool belt that can help you get the home that you're looking for in any market. So it's all about temporary buy down. So Tucker, what's a temporary buy down?
Yep. So Dan, you hit this on your intro segment. Is we're trying to allow buyers to feel comfortable with their monthly payment. Like that's the biggest thing here with rising interest rates. Payments are becoming unaffordable or uncomfortable for a buyer. And so a temporary buy down allows us to request a credit from the seller and or the lender, but it can only be the seller or the lender, a dollar amount figure that can lower the monthly payment that the buyer pays over this first number of years of that loan. So it could be a 2-1 buy down or a 3-2-1 buy down. And essentially we're getting dollars from the seller, holding them in an account, and then spreading them across the future payments to offset what the buyer will be paying.
So how is a temporary buy down different than a permanent buy down?
Yep. So temporary is the key word here. So what we're doing is, let's say for a transaction, we get a $20,000 seller credit, and with a temporary buy down, we spread that $20,000 over the first 24 payments. So the buyer saves a full $20,000 in years 1 and 2. So substantial savings right up front. So that's how a temporary buy down works. With a permanent buy down, what the buyer is doing is taking that same credit and buying down the interest rate permanently over the 30-year term. However, the impact of that permanent buy down is far less than what it would be if we spread it just on those first 24 payments. You know, we're talking maybe $200 to $400 a month difference if we do a permanent buy down versus a temporary buy down where we get a full $20,000 in years 1 and 2.
Is this an instance where you're looking at the 24-month kind of idea, and it may make sense to refinance at that point because there might be less pressure on interest rates at that time?
Exactly. So it's a similar concept to an ARM product or an adjustable rate mortgage, where this isn't necessarily a 30-year permanent solution. We're using those 24 months to get through this period where we have the Fed increasing rates and we have upward pressure on mortgage rates. Our thought process is that sometime within the next 2 years, hopefully, we will have a better opportunity to refinance. And so with the temporary buy down, it takes all of those future savings and just front loads it up until the first couple of years of the payment to get the buyer in today, allow them some relief right away, and we'll monitor and we'll look for an opportunity to refinance. The really cool thing about temporary buy downs that I'll add here, Dan, is that if we get to an opportunity to refinance, this buyer gets to take whatever amount is left in this from this temporary buy down and reduce what they owe on their loan and refinance at a lower amount. So they don't lose any of this credit when refinancing. Whereas if we do a permanent buy down and we buy down the rate, and let's say it costs $20,000 to buy down the rate permanently, there's a break even point that's out in the future some point. And so if that break even point 6 years from now or 7 years from now, and we refinance next year, that permanent buy down did nothing to help the buyer today.
Right, because that's amortized over 30 years.
Exactly, over 360 payments. Yep.
Can you do a buy down for 3 years?
You can, yeah. We can really structure it however really we want. We can do 3-2-1, where you get a 3% break the first year, 2% the second year, and 1% the third year, and then the start of the fourth year is when your permanent interest rate would kick in. Or you could do a 2-1, where it's 2 percentage points the first year and 1 the second year. The key component is how much is the seller willing to give us, because a 3-2-1 buy down is of course going to cost more to the seller than a 2-1 buy down.
I gotcha. The interesting part about that is you essentially are giving yourself a bit of, the seller's giving, because we're going to talk about how this helps the seller in just a second. So let's talk about that part. How does it help the seller?
Yeah. So, from a mortgage perspective, we're always looking at this from a monthly payment standpoint, and how does it help the buyer? But when we flip it to the seller, to get the same monthly payment savings. So, we're talking $1,000 a month for year one and maybe $500 of savings in year two. How do we get that same savings from a seller reducing the price? So that's where this really benefits the seller. For a seller to have that same impact to the buyer with the payment, they would have to reduce the price of the home by hundreds of thousands of dollars. To get the monthly payment to drop $1,000, you're talking well over $100,000 price reduction. So how it helps the seller is they are only giving up maybe $20,000 in proceeds and preserving that extra 80 or 110 or 120,000 that they would otherwise have to give up in order to sell in this market to make it comfortable for a buyer.
Yeah, that's great. That's a great tool. Thanks for bringing that up.
Absolutely.
So where do you see interest rates headed?
That's a great question, Dan. If I could answer that, I probably wouldn't be a loan officer. I'd be in the hot seat for Guild. But we're of course looking at this from a glass half full perspective right now. So we do anticipate that for the next 30, 60, 90 days, we're going to see rates kind of teetering here, maybe going up. But we do believe by the end of the year, they're going to start heading back down. Yeah.
Like I said, I think we saw in the last 6 weeks, interest rates go down from their high at like 6.25, and they came back down to mid fives. And I think really there's an emotional reaction in the bond market. And it really is, based on these hedge fund guys trying to figure out how where the market's going, and we're seeing volatility. And so to have the tool like the temporary rate buy down, it's fantastic. So awesome. You know what, Tucker, I always appreciate you coming on the show, and we've had a bit of a hiatus, so it's good to have you back on here. How do our listeners get a hold of you?
Yep. So I'm on all the major platforms. So Tucker Maxwell at Guild Mortgage. You can find me everywhere. Phone number 425-757-9202, or you can email me tmaxwell@guildmortgage.com.
Perfect. Well, thank you so much, Tucker. I appreciate you coming on. Until next time, enjoy this fantastic summer.
Absolutely. Thanks, Dan.
All right. We're going to have a short commercial break. Then we're going to be welcoming Samantha Kennedy with Mainsail Financial Group right after this short break.